Good morning, IA&B members. My name is Jason Ernest. I'm CEO of IA&B, and it is my pleasure to welcome you to today's webinar as we review the 2023 P&C Insurance Marketplace Summaries. Before we begin, just a couple logistics, typical logistics for the webinars that we've been hosting. First, as mentioned, all attendees are muted. For a group this size, it works best to mute the attendees, but we are still very much looking forward to your questions, and we will take questions at any time throughout the webinar. I'll be moderating those questions and asking Paul questions as they come up. So please use the chat feature as part of this video conference to submit questions at any time. I will get to as many of those as possible throughout the webinar. We'll take some time at the end to address questions. Please also know that we capture all questions. So if by chance we don't get to any questions, we capture a history of those chat questions, and we'll always follow up with the answers to those questions after the webinar if needed. Today's webinar is being recorded so that if you need to go back and review any information, if you want to share with anybody in the office, certainly can do so with that recording. We'll provide that shortly after the webinar. We will be promoting this to all membership for those that couldn't make it today during the live part of this session. Finally, we are going to provide a summary of the summaries, the marketplace summaries today. Paul's going to highlight the data that's coming out of these summaries and touch on some key points from that. However, at the conclusion of today's webinar, we will be posting the full marketplace summaries for Pennsylvania, Maryland, and Delaware so that you can get into the full summaries, review them, drill into any areas that you wish to drill into, areas that we might not cover today. But again, we'll be scratching the surface. You will have access to all of that on our website under the member resource section. This is a member-only benefit. So you will need to log in, but you'll have access to that. We do have a partnership with Virginia and Washington, D.C., so those reports are also available. And then shortly, there will be a national report provided by our national association, so you also have access there. So again, you can dig into this as much as you want. So with those introductory logistical comments, let me now introduce Paul Buse. Paul is founder of Risk Real Insurance Solutions Consulting, and Paul is the creator of the marketplace summaries. This is the second year that IA&B has been participating in the marketplace summaries. We had a great deal of interest last year, and that interest is only growing this year. And I think it may partly be due to the market changes that we have seen over the last year and the hardening of the market. So we will certainly touch on that, but I think that's where a lot of the interest is coming, and the data is going to point to some of the things that we are seeing. Paul is a 35-year, has 35 years of experience in the insurance industry. He himself was an independent agent. We came to know Paul through his 20-plus years of working with the Big I, our national association, and worked closely with Paul in that role and worked with him in various aspects of the industry. But we are excited to, again, welcome him to meet with you guys to discuss these marketplace summaries. Again, any questions at any time, submit them via the chat feature. I'll pick up on those and ask them of Paul. But Paul, the floor is yours. Feel free to take it away. If you want to put your camera on and start your slideshow, we are ready to go.
Thank you, Jason. Welcome, everybody, and pleased to be here this morning, sharing a bit of the data and hopefully inspiring you coming out of the webinar today. Not only with a little bit of knowledge, because I think Jason really hit the nail on the head in terms of scratching the surface of what we can when we're talking about 3 states and 50-plus page marketplace summaries. And so I'm pleased to be able to introduce you to that. Jason gave me some credit for being the creator of these, but really with that 20-plus years of time at the National Association working with Jason and all his colleagues in the 51 states, it really came from that. I happen to have the skill set to be able to take it forward and replicate it, just because I used to do a lot of consulting and the data side prior to coming to the Big I when I was at Aon. But it really was the state association initiative, and I think the Big I states, and credit to all of you for belonging and supporting your professional trade association, because it's that sort of joint activity that I think really raises the level of who you are as independent agents. But also it helps the industry, and it helps the insurance consuming public. So the data, which we'll talk about today, with the news every single day, I have to tell you that the data sheds light on something for me daily. And I'm going to try to give you an example of that in Delaware, Maryland, and Pennsylvania at the end, after we cover some of the broad brushes of what is in these marketplace summaries. And hopefully that will pique your interest a bit. But when you watch the news, as we all do in the trades, I mean, oh my God, right? It reminds me of when I started in the industry in the mid '80s with the hard insurance market, catastrophes. Then it was more of a legal driven catastrophe. I think we're seeing more weather related concerns with populations closer to coasts, but also a spread of more severe weather. Insurer profitability is not where the industry wants it, and that impacts us because we sell their product, right? Inflation is a significant factor, and we'll see a bit of that. And then we have all the movements and shaking out of things happening in the marketplace with insurtechs in the news. All of these things, data can help us understand, and the outcomes in our industry of, for example, growth of surplus lines is something that, as independent agents, you feel, but you should also be aware of it from a leadership standpoint and react to the differences placing surplus lines. So we'll talk about that, but just a quick anecdote. When I think about the data and doing a webinar, sometimes I'm a bit daunted because industry data is wide and deep. It reminds me of sitting on the side of a lake. You look out, it's a lake, right? And if you don't have something specific that you're thinking about or looking to, the data can be overwhelming and perhaps I'll say boring in its aggregate. And there's some risk of that. So I always am cautious when we do a webinar to try to make it as interesting as possible by giving context. And we'll do that a bit today. But I do want to make clear, as Jason pointed out, coming to you is both the Pennsylvania, Maryland, and Delaware P&C Marketplace summary. It is specific data to your state. This is not new. The data has always been available. It's a lot of work to parse it and present it state by state. And I think that's why you sometimes see it, but more often than not, you see the aggregate data for the United States and in industry trends. So it's very helpful for you as agents in your states to know the situation in your state, because it can be very different state to state. And you have access to these through Jason and his team, but you also have access, as he mentioned, the national version of this. That'll be available on the Big I website, and I think they'll make you aware of that through Insurance News and Views, their weekly newsletter, and IA magazine, and those sorts of things. So watch for that, and hopefully we can cover a little bit and give you the sort of background. So when you look at your marketplace summary, you know what's there. It's not something that you'll page through it, but it's not something that you read like a book, right? It's a resource, and hopefully you keep that around for the entire year and take advantage of that to help you and your agency with questions that come up or insights that you may share with your customers. So you've got the 3 states in terms of the broad brush of what is in the marketplace summary. Today we'll start with, and we'll go over some of the premium data that's there. We'll talk about the 3 states and where they fall in the pecking order of the 50 states and so forth. We'll talk about trends. We'll talk about the loss and combined ratios. It's important that you understand the version of the loss and combined ratios that's in the marketplace summary report. because there are different versions. We use one that is the most helpful to us in our direct experience of the marketplace. You can get these numbers on a net basis after reinsurance. We always concentrate on the direct impact because that is the sum of the policies that we and our competitors write in the marketplace. Distribution styles of interest oftentimes to our carrier partners, the associations, but also to you because we're a part of the biggest sector of distribution within the property casualty industry. We'll look at that. I'll talk a bit about it today. And penetrations of independent agents overall in the states does vary quite a bit. And the competition, whether it's a Geico direct competition or a State Farm exclusive, as an example, versus our many companies that we have access to. We'll talk a bit about that. We'll look at the trends. We have to be a bit broad brush, but you do have in your marketplace summary the trends in the top 9 lines of business. That's what those clustered bar charts there, and we'll look at that. I make the point, although it's not a part of the presentation today, but every insurance company does have to file their commission data on a state by state and line of business basis. That can be a useful tool to you in perspective on what your commissions are compared to the average. And we'll look to the actual marketplace summary report to give you a bit more information on that. We do look at the top insurers by line of business in the state, by distribution style. And then finally, one of the things that I think is unique about these marketplace summaries is that for each carrier in each state, I do look at their licensing status and put their premiums into a bucket if they're surplus lines. And what we're seeing countrywide is a growth in surplus lines. So we'll take a look at that data.
Quick question came in.
Sure.
The data, this is the 2023 marketplace summary. The data is the entirety of 2023, certain quarters within 2023. What comprises the data for your reports?
Excellent question. So we'll see that, and you'll see some clear examples. But the 2023 marketplace summary report is the 5 years prior to 2023. IA&B also subscribes to the quarterly updates to that. So first, second, and third quarter will come out during 2023. But the marketplace summary report and the vast wealth of data is only available on an annual basis. And it kind of speaks to the slide that's in front of us today and how we come to having access to this data. But the quick answer to that question is the marketplace summary that we're talking about today in each of the states is 2022 and the 4 years before that to allow us to look at trends and all the details that are available, with quarterly updates coming during the year, mostly focused on premiums, because those quarterly summaries are a bit briefer in what the insurance companies are required to file. But this yellow, as I call it, yellow book road or yellow brick road, obviously playing off of, is named after that center top. I think I just grabbed that from the internet somewhere, a picture of an actual historic yellow book. That is what the annual statutory statement of property casualty insurance companies is and has been referred to, more so in the past. Now that we've moved to the internet, I think there's images of the yellow pages, but more often than not, it's a PDF without color. But the yellow book is required to be filed by all property casualty insurance companies that are domiciled in any one of the 50 states in the District of Columbia. That data is very standardized in what the carriers report and how they report it. You can think of it as being audited because it's looked at by the regulators, and the actual, if the insurance company's audit outside of the yellow book statement, that audit is also part of their filing. But all of that data is aggregated by the National Association of Insurance Commissioners and made available to anyone to purchase. Fortunate for us and me in particular, there's organizations like AM Best, some other ones, S&P and a few others, grab that data from the NAIC and make it available in a format that's not as labor intensive to go through. They make it so you can pull the reports. That's what I do to create these marketplace summaries. I pull custom reports on every individual policy insurance company by state, and I use the data from the groups and the fleets that they belong to, the disclosed marketing types, and all the lines of business, along with some industry reports that AM Best does a great job of creating to create those marketplace summary reports. So today, what can we cover that will give you a good starting point to looking at your marketplace summary report? I'm going to touch on the premiums that are in there. Obviously, I can't hit all of that's in each, but I do want to give you that sense and those various touch points so you know what to look for and can see what's there. We'll look at the losses, and I'll talk a little bit about the particular type of loss and combined ratio that's presented in the report. And then we'll talk about the lines of business that are available to you in a very detailed way for your specific state. And then time permitting, we'll follow up at the very end with 3 questions that I looked at or that arose yesterday that applied to Delaware, Maryland, and Pennsylvania, just to give you that kind of a sense as to what the data might do for you with a question in your agency or something that you might enlighten one of your clients with in terms of insights of the industry and how it's impacting the policies that they purchase. Premiums. So we're going to start there. And I'm going to show you some of the facets that are covered in the report. But given that we have 3 states on the line, I've taken all of the data from all 50 states and I've given it to you so you can kind of see the high, the medium, and the low, and where Delaware, Maryland, and Pennsylvania falls. But the graphic that you see in front of you here is from the United States report. It is the entire property casualty insurance industry in the United States. There you can see 2018 through 2022. Those are the 5 years. And you can see, hopefully you can see that $861 billion in direct written property casualty premiums in the United States in 2022. We're also going to look at that on a per capita basis, because obviously you might guess that the biggest state is going to be either California or Texas. And the smallest state you might guess is, Vermont or Wyoming. But I'll show you that, and I'll show you where the 3 states fall in, both on the direct total premiums and the per capita. We'll look a little bit at the distribution styles and how independent agents are doing. And obviously that trend is also captured in the marketplace summary reports. We'll talk about growth rates, right? That's the inflation of our industry. And then we'll talk a little bit about the lines of business as we go forward. But just a quick insight on that graphic that you see there. That is the approach that's taken on all the lines of business and the overall of showing you not only the total industry premiums, but also that independent agent component of those premiums. That $537 billion is the independent agent estimated distribution of the 861, about 62% nationally.
Paul, quick pause here. If we can go back to that slide, and I knew this would come up, and I think where a lot of the interest is being generated for today's webinar. We're obviously in a quickly hardened market right now. When we look at this increase in premium, would you suggest that this is partly just because premiums are going up, or does this reflect new risk in the marketplace that are being written? Can you summarize, based on the hardening of the market, where this increase is coming from, and do you think it's tied to a hardened market? And I have a follow-up to that after you opine on that.
Yeah, so absolutely. I feel like I started my career in the hard market in the mid '80s as an independent agent. So we are
and you
clearly
just touched
seeing...
on. I'm gonna have you pop the question. Of course, is that for those of us not dating anybody here, but looking to you as a historian of the '80s hardened market, what caused that? What similarities do you see between the '80s hard market, today's hard market? Anything we can learn from that? And then back to the question I asked: is premium growth directly related to that?
Yeah, so I would say absolutely. So the overall premium growth rate we'll look at in a minute, and I actually will give you some perspective on inflation because I did go to the Bureau of Labor Statistics yesterday and just grabbed the last 100 years, just so we can all go into it with a perspective of what is high inflation and what is not. Now, that's general consumer inflation. Insurance premium inflation is usually driven by something. Unlike today, although I would say that in some parts of the country, the drivers of premium increases have been the legal environment. The mid-'80s was clearly driven by what they referred to as a liability insurance crisis. There's a famous Time magazine from the mid-'80s that when everybody read the same magazines, it was a bigger deal. But essentially it said, America, your insurance has been canceled. And it was a crisis that was created by the legal environment as, if you will, the proximate cause. But there was intervening factors as well, which is a good parallel with today, inflation being one of those. Carriers charged premiums, and they charged them based on one insurance inflation assumption, which became something very different. And so they didn't collect enough premiums, not anticipating the high rate of costs of settling claims. And if you have a liability driver as well, or if you think claims are going to settle for an average of $1 million and they settle at 5 million, carriers begin canceling policies. And I don't want to get too detailed, but the mid-'80s also had kind of an interesting component to it where surplus in the industry became strained, because as the premiums rose so quickly in the mid-'80s, the carriers didn't have the ability to add surplus to their balance sheet. So they became even more constrained in what they would write at these higher prices. So they became even more selective. So it became a nothing changes until everything changes all at once. Going to the 785 to 861 is about a 10% premium increase, which is higher than inflation during that period of time. And I don't want to get ahead of this because I've got a good graphic on this. So I'll touch a little bit more about price changes overall. Jason, I'll stick more to the question of what's driving what we're calling a hard market now in the United States. I think what we're seeing in the United States now is a very geographically segmented market. There's some consistent hardening across lots of lines, commercial property being one, condominiums seems to be hard in a lot of places. Over the past 4 years, I would tell you that other liability claims made, so errors and omissions and directors and officers was hard over the preceding 4 years. But really the catastrophe driver is really impacting a lot of the premiums that are going up right now. So I would say, if you put one finger on one thing, I would say it's mostly property driving the price increases, and catastrophe risk, whether it be the hurricanes that we all think about, or the convective storms that we're seeing more all across the country, hail being widespread damage in a lot of places, and wildfires in the western states. So great questions, keep them coming, and hopefully I'll show some data that speaks directly to that. Let's take a step back to the overall perspective of what's in these P&C marketplace summaries. Obviously, we look at total premiums, all lines of business. This is 32 lines of property casualty business that the carriers have to report in their annual statement and that we can look at. 26 of those lines are the ones that we're the most interested in, but there's a few smaller lines like warranties and some other things that are also in these premiums. But here you have the whole United States, from the biggest of the big, which is California, to the smallest of the small in Vermont. And here we have Vermont, Delaware, coming in at 41st. I think the RD should be an ST, and $3.5 billion in annual premiums. Maryland coming in at 14.8 billion and 22nd, and Pennsylvania 6th at 30 billion. So represented by IA&B is one of the big dogs, as we would say in the industry. Pennsylvania, you've got both Pittsburgh and Philadelphia that drives a lot of economic activity, as well as many other cities in the state, and a fairly robust ag sector, and that results in 30 billion in premiums. So that's where the total premiums shake out. Out of the 861 billion, in the United States in 2022. Again, that's all lines. It's always helpful and a bit of a leveler to look at the per capita premiums because it gives you a bit of a sense as to price levels in individual states, but also an underlying component that's a huge factor when you look at the number one state there, North Dakota. To the extent that there's less people in the lower denominator, you will see premiums spike up on a per capita basis, and that's what North and South Dakota shows us as being the highest. And that is largely driven by agricultural related premiums and a smaller number of people. But when we look at the per capita and where Pennsylvania comes in, Maryland and Delaware, Delaware punches a bit above its weight class in the per capita premiums, and that's probably not ag, maybe some Eastern Shore ag, but that's going to be primarily driven by fewer people and more commercial lines premiums. Pennsylvania being more of an even spread state, maybe a little bit more proportionally rural and lower premiums per capita, and Maryland being all things in miniature, right? America in miniature, you used to say. I used to live in Maryland with all facets and components. They come in right where you expect, in the middle. So that's the per capita. That is provided for you in the report as you benchmark. The average for the United States is slightly higher than Maryland and Pennsylvania at 2,585. Surplus lines. I really like to make a point here. If you remember only one thing as a walk away from the webinar today, Jason mentioned my time at the National Association. Well, one of the biggest things we did, and one of our most frequent interactions with folks like Jason and his team, was on the E&O program with Swiss Re and some of the alternative markets that states have available to them on insurance agents, errors and omissions. And the reason I'm bringing that part of my background into the conversation is that this is a big impact on your E&O risk, and it is growing. In some states, in a relatively dramatic fashion. Here you have in alphabetical order the 50 states and the District of Columbia, and the percentage of surplus lines of direct written premiums by domestic carriers in your state. This is slightly underestimated as a percentage of all the premiums in your state because it does not include alien carriers like Lloyd's of London because they don't fill out yellow books. So their data is not captured by our process. It's maybe a point or two added to these numbers. But when I put your three states up there, Delaware at 8%, that's 8% of the premiums in Delaware are written on a surplus lines policy. Maryland 5% and Pennsylvania 6%. There's no state that this isn't growing as a proportion of the overall marketplace. And my takeaway and reminder to you is to remember document, because it's more likely than not that we will come across the need for a surplus lines placement in the coming years as we see what the marketplace is doing. And that is a more variable, less reliable scope of coverage than what you have in an admitted policy that's overseen by your state insurance department. And it's an E&O risk. So the thing to remember there is document, and that you've got data in your marketplace summary reports that will show you what that number is for each line of business, as well as the overall trend. The United States is higher than all of your states. Delaware is close to it at 9%. Some of the highest states, California over 15, Louisiana, some of the states that have seen some of the marketplace challenges because of their coastal or other exposures do have higher percentages, but it seems like all states are heading to higher surplus lines numbers. Talking about distribution styles, I'll just hit on this because I do like to make the point as to how we arrive at that independent agent penetration. The galley process at AM Best is how that results. Every carrier that goes through the galley process, which includes those rated and unrated, Generally speaking, most carriers, the vast majority go through the galley process, and they disclose how they distribute their product. What is AKA their marketing type? These are some of the example marketing types that are put down by the carriers. And believe it or not, every permutation and combination possible. What I do is I take all those possibilities and I put them all into each carrier into a category of one of the 6 main distribution styles. Pure IA, MGA, and IA mixed are combined for, generally speaking, what we look at as independent agent distribution, and exclusive captive, State Farm, American Family, direct, Geico, USAA, and then there's 1 or 2% that fall into the other. But just some quick examples that I want to keep us moving to hit to the end of all of our slides. Here are some examples that are clear. Travelers, very good independent agency companies. Cincinnati, Westfield, Erie. You're going to know the companies that you work with. Those are, generally speaking, they say independent agent or broker as their marketing type. Evanston's Markel Company, one of the larger ones nationally in terms of total premiums, that operates through MGAs, ultimately, and 95+% of which is distributed through independent agents and brokers like yourselves. Factory Mutual is a great example of what that IA mixed is. They do have a bit of a direct component in some states, but they also distribute through independent agents. State Farm, Geico, and Berkshire Hathaway is a good example of somebody who's in the uncategorized zone. So what do we get in terms of penetration rates? Here are the 50 states, again, alphabetical order. We've got our 3 states and where you all shake out. Delaware at 56%, Maryland at 51%, and Pennsylvania at 67%. And there probably is questions as to why I think those come in where they do. And I've got some theories on that, but I don't want to take too much time. And I do touch on it, I think, at the end. But I'll real quickly say Delaware. I think you've got one big component there, and we'll talk about it, is a large company that distributes directly nationally from Delaware, but also a fair component in the personal lines space of direct and captives. Maryland, the home of Geico, drives that one down. Pennsylvania is actually higher than average, and the United States comes in at 62. So Pennsylvania, not surprisingly, having a great trade association and many strong independent agents, does a good job of keeping that penetration of independent agents high in Pennsylvania.
Paul, correct me if I'm wrong, but those numbers have been stable for some time. I mean, the foreseeable historical view of that is stable, if not slight growth with the independent agent penetration, correct?
Correct, and even better than that, it's growing, right? So we'll see that the independent agent marketplace footprint is growing. There was a period of time when it was falling earlier in my career, late 80s. I can only imagine. I didn't do this work back then, but clearly independent agents and the rise of direct distribution in personal lines did erode the independent agent penetration, but that was long ago. I think if we look now on almost every state, in every case, independent agent penetrations are growing because we're just better at solving problems, and there's problems in the industry. So it's a very good time to be an independent agent. We're better equipped to solve problems. But I think some of that may pop out here in the premium growth rates. We'll look at the United States versus the states, and then we'll look at some of the 1-year and 5-year growth rates on individual lines of business. Here's my Bureau of Labor Statistics chart that I love the Bureau of Labor Statistics. You can go there and get just about anything you want, and they make it easy to grab it in some easy Excel spreadsheet version. Here's the last 100 years of consumer price changes from 1923 to 2023. And the takeaway here is, obviously you can see the high inflation and the deflation and the Great Depression in the 20s and 30s, and then periods of inflation after the Second World War. But then where I was coming of age in the late 70s and 80s was a high period of inflation, which did drive that mid-80s, partially drive that mid-80s hard market. Well, then here we find ourselves with this period of recent inflation that the Fed has been so focused on bringing down. And the takeaway for me here is that the 80% of the years here are below 5%. And that's not generally what we're seeing in the insurance marketplace. When I look at direct written premium changes, again, we've got alphabetically here, all 50 states and the District of Columbia. I should have left a 5% line there, but if there's a state below 5%, I can't recall which it is because most of these are well above that. Again, this is the annual premium, direct premium, all lines of business premium change for all 50 states. And then here we have Delaware, Maryland, and Pennsylvania. And Delaware and Pennsylvania being a little bit higher than Pennsylvania. I will say, I think this is just a precursor of more to come. Half of our industry is personal lines, and all the catastrophes on the homeowner side and the repair costs on automobiles are a big factor right now in premiums being a little bit too low for most carriers to be able to make the return on equity that they want to make. And so I think that these numbers are definitely going to be higher in the current quarters as the quarterly summaries come out. They definitely were in the first quarter of this year, but the second and third quarter and then next year is going to show premium increases greater than inflation, certainly, and greater than these numbers that we have in front of us here. Now, the next chart I'm going to show you is that averages are averages, right? But that's certainly not the case when we look at all lines. Here you have the United States overall at 10%, which is higher than all three of your states, with some of the higher states like North Dakota, District of Columbia, South Dakota, Florida. I think Florida is going to see, Florida's a little bit covered up there. But some of the more catastrophe prone states are seeing premium increases. But I think it's fair to say it's just getting started. But when we shift our focus now to the lines of business, here you have the 26 lines of business that are highlighted in the report. Not in this are some of the lines like warranties, accident health, mortgage guarantee. There's a couple small lines I should have more on top of mind, but the 26 lines that we as independent agents focus on, everything from aircraft to workers' compensation, are on this chart. And you can see there's a fair degree of difference in both the 1 year to the 5 year, the lighter bar being the 1 year, the 5 year being the 5 year average. Now, let me make clear that 5 year average is the compounded percentage growth change. That's not 2018 for all commercial auto. It wasn't just a 10% increase in commercial auto from 2018 all the way to 2022. That was 10% every year compound. So those are every year, year in, year out. Even in spite of that, now that you realize that those numbers are the compounded numbers, commercial auto is at 11%. I think that's one of the lines that we're seeing a fair amount of premium increases. Allied lines, allied perils being one that's high. Multi-peril crop is something that most agents on the phone today aren't focused on, but I can tell you from working with the Midwestern states, it's either too much rain or not enough, and rarely is it perfectly in between these days. And the multi-peril crop coverages are paying out a lot on those losses. One other thing that jumps out, I think this is one of those things where if you're looking at an ocean of data, it's not until you look at the shoreline and see the raft of ducklings and the duck that you realize that's what's interesting to you, or the killdeer that's hunting bugs along the shoreline, that you really start to look at things more specifically and the interesting things pop out. Like one of the things I see here is federal flood is shrinking in total premiums. That's astounding to me, given that we all know there's more floods than less in the last couple of years, if the news media is any indication. But once you look at that, you should also shift your eyes to the right. These are alphabetical. Private flood is growing and growing at a very fast clip. In fact, last year, One state actually saw more private flood premiums than federal flood premiums. So we're seeing a big shift in the marketplace. The other one that jumps out to me as very interesting, is near and dear to Jason's and my heart, is that other liability claims made only growing from 2021 to 2022 at 3%. That to me is astounding, given that the 4 years before that, it was growing at just a terror. The premiums on other liability claims made, so that's errors and omissions, directors and officers liability, and a lot of the cyber, was really driving a fast growth rate on that line of business nationally, and that 16% average speaks to that. So it's hard to talk to these. There's a lot here, especially when your agency is concentrating on a line of business. And that's what I hope is to inspire you to think about those lines of business that you write in your agencies. And then we'll get to it here in a little bit, but that line of business detail page and the wealth of information that is available to you in these marketplace summaries that you can look to. Before we get to that, however, let's talk a little bit about loss ratios. Looks like I'm at 10:41. We've got good time to talk about some of the loss data, because this is very important to you in terms of understanding what's driving the carriers. I want to make the point here that these are direct results. These are not net results. These are results before reinsurance. This is the experience of all the policies that we and our competitors write in the marketplace. Carriers are oftentimes more focused on net results after reinsurance, after they pay out some of the direct premiums to purchase reinsurance and receive reinsurance recoveries. What we experience in the marketplace is what ultimately drives the marketplace in the long run. And it's what's most important to us. But keep that in mind and watch the industry news and pay attention to whether it's net or direct results, and sometimes gross results, which includes reinsurance that a carrier might take in as a revenue line. But most often it's direct and net. I want to define for you the loss ratios so you know exactly what those loss ratios mean. We'll do that on the next slide. I want to make sure that you understand that you can see both the loss ratio that I'll explain to you and the combined ratio for each line of business, and for the overall state results. This is the United States that you have in front of here for all lines of business, all in, with the 68% loss ratio in 2022 calendar year, with the 98% combined, and that's on a direct basis. I'll talk a little bit about definitions because they're important. Not that you become an expert in them, but you have kind of a sense of what the loss ratios are telling you when you see one that looks strange to you, or you understand what all went into it. They are adjusted calendar year loss ratios. The adjustment is in the denominator. That is, the earned premiums are adjusted for any dividends that are paid out on that line of business. Generally speaking, dividends are paid out on prior years, but they're deducted from the earned premiums in the current year. A lot of times this is not a factor. But if you're going to compare workers' compensation to personal auto, and you want to look at the loss ratios, you sure ought to take into the dividends into account on work comp if you're going to go apples to apples with a line that doesn't often have dividends paid out on it. Not to say that there's not some dividends in personal auto. The numerator is where the loss ratio comes from, and of course that is the paid losses in the year 2022, if we're talking about the 2022 loss ratio. It also includes the reserves that are set up. So if a car crashes and there's a $5,000 payment immediately and a $25,000 reserve, that $30,000 for that policy is going into the 2022 calendar year loss ratio. But those reserves, oftentimes they're not all used in that year, and prior year reserves carry forward. As those claims are settled, if the reserves were either inadequate or too high, those adjustments are accounted for in the calendar year loss ratio. So the reason I make a point of that is sometimes on individual lines of business in individual states, or even on a carrier specific basis, you'll see a negative loss ratio. That almost always is going to be the result of a prior year reserve takedown. So keep that in mind. It's not a factor, or it's not as counterintuitive when you look at total lines and total states. in bigger buckets of premiums, but sometimes it does pop up. So let's take a look at those loss ratios. Here we have, that the United States loss ratio was 68%. And that's, as they say in that one song about rent, that's too high. Generally speaking, for the overall industry, carriers are looking at what they can do to reduce that loss ratio. That's a bit higher than the overall industry average is, generally speaking, going to be comfortable with. A little bit higher than generally our independent agent companies even want. Some of the direct writers sometimes can get away with something in the mid 60s and still make their return requirements. But here you have Delaware, Maryland, and Pennsylvania, 67, 66, and 63. So all loss ratios in 2022 below the average. You all represent good loss ratio states in a way of thinking from averages. And I'm not terribly surprised. I mean, you've had your events that have driven losses. You aren't immune from hurricanes. And when I lived in Maryland, I well remember the derecho that rode through there and clearly spiked the Maryland loss ratio maybe 10 years ago. But for the most part, last year, you were not hit with some of the weather-related events or other things that really drove losses in a big way. And so your loss ratios are coming in a bit better than average on that 1 year time frame. Again, the data in the full marketplace summary report will give you that on the 5 years, and I'll show you in the line of business summaries here in a moment how you can look at that in a more detailed way. But here we have, again, making that point with the United States data that you are provided with the 26 lines of business that we mostly focus on as independent agents. And here we have the 1 and the 5 year loss ratios by line of business. Again, this is a great example of what is interesting is what you probably focus on. But if we're looking at homeowners, right in the middle there at 71% last year, 60%, 7% overall average, five-year average. That's higher than, generally speaking, the industry wants to see. We're always, I like to think of things in the low 60s as being an overall broad brush, very line of business dependent, but it's probably not a terrible number for homeowners. And that's high. But then multi-peril crop that already mentions too much rain or too little. But some other lines, federal flood being one where as the premiums fall and losses have not shrank, results in a high 1 year loss ratio there. But overall, the numbers are there. You can see the total all lines, 68% on the far right, with the 63% 5 year average being more what you look to.
Paul, a quick note, something that sticks out to me: private passenger auto at 81% for the most recent year. Any feed that's high, and especially after coming off probably a very low loss ratio for the pandemic years when a lot of people weren't driving. Is that severity, frequency? Well, what do you think for that 81% private passenger?
Well, I'm seeing all of the above, right? So the distracted driving, and boy, I just drove from northern Wisconsin to southern Wisconsin. And I can tell you, nobody's going the speed limit anymore, and there's lots of distracted driving. So I think that's an ongoing trend. And as people are driving more miles, that is also a factor. But clearly, supply chain is a driver in all of this. The inflation that's taking place in the cost to adjust claims is clearly a factor. All the personal auto carriers, if you're following the trade press, you're seeing the ones that wrote the most auto are cutting back or raising prices to the extent that they can. And they have to, because they just didn't charge enough for what they're seeing in claims costs.
Back to inflation being a main driver on this and causing this premium increase situation. Okay.
And the carriers are all smart, but I don't think everybody quite foresaw the expense of all the electronics that are going into cars. And that's before we even talk about Teslas and the costs associated with a battery that burns up on the side of the road. I mean, it's obviously a total loss in the car, but there's all these other ensuing expenses where they can't even figure out how to put them out. So there's things that the carriers are wrestling with. Tesla and the electric car manufacturers are going to have to figure out how to insure their product, because I think there's some carriers that have figured out they're heavier, they create more liability severity, and boy, there's lots of reasons that a person is struggling. The last one of which is the billboards from all our friends in the legal profession, that you can't go anywhere in this great country of ours without seeing a billboard that would make you aware of the fact that you can quickly hire an attorney to help you with your personal auto injury claim.
And an earlier question, now is probably a good time to address it, is based on the experience from the 80s. Is there any prediction of when a hard market will ease? And if it is so driven by inflation, you've touched on that several times during today's session, is it a matter of inflation eases and the hard market eases, or is there a way to predict, or are there just too many other factors to get into the art of predicting when we may get out of this?
Yeah, it's I mean, how long did that 80s hard market? It went on for a while, but it's a very and not to use the overused Adam Smith invisible hand marketplace. I mean, it's not that hard to get into the insurance business, and low loss ratios are often exploited, forcing the existing insurance industry to react. So I don't think I can ever foresee a hard market going on where competition doesn't make sure that it's not too hard. We are seeing increases in costs. There's a lot of discussion around financing of litigation by private equity, driving up the cost of insurance everywhere. Florida, where my full-time residence is a great example of insurance costs being too high, largely influenced by litigation and all kinds of marketplace tools that make litigation a greater cost. So I think it's years. I think this one is going to be harder to overcome. It's going to take a while for this to work itself out, and the catastrophes seem to be just coming. The second quarter of this year has catastrophes. I should be able to quote for you, but yesterday's news had something about the second quarter being one of the highest so far, and we haven't even really gone into the hurricane time of the year, which drives those total numbers. So
yep. Yeah, we had a quick note on the charts just being horizontal in nature, would be easier to read up and down, but just keep in mind, we're simply illustrating some highlights here. The full report that you will have access to, you'll have the ability to look at these in any form you want, but certainly note that. So please continue, Paul.
Yeah, this particular chart violates every tenet of good chart design, but when it's on a horizontal page, I did flip it. In the actual report itself, these are horizontal, vertical bar charts, because my dad, who was an economist, would yell at me for conveying a time. You're never supposed to do a horizontal axis on something that doesn't convey time, is what he taught me. So apologies on that, but yeah, it just fits better on the screen from a legibility standpoint. I won't take a lot of time here because we're going to run out. But I do want to make you aware that these combined ratios are good combined ratios. Included in each combined ratio is the calendar year loss ratio that you're now all experts on, and how those are arrived at on a line-by-line basis. This, of course, is all those lines combined together in the United States in front of you with that 68% in the 2022 year. That 98% looks like a broad brush, 30% added on top. And that is the average added on top. But I want to make clear to all of you that the combined ratios in your report are exactly calculated, and they do accommodate the allocations of the general expenses in as specific a manner as possible. That includes the commissions. So it's the commissions by product that are in the combined ratio, that difference between 68 and 98, but also the specific premium taxes, the allocated loss adjustment expense. So if on an auto policy, a lawyer is hired, that's allocated loss adjustment expense. And that is included line by line by line. So that's parsed out into each line. And so too are the general expenses more specifically allocated to each line based on both written and gross premiums including the adjustment expenses of the overall company, are allocated not generally in a broad brush way, but also influenced by the overall loss level of that line of business. You extract a little more of the unallocated loss adjustment expense. So know that when you look at a combined ratio in the data, it is a good combined ratio, because that 68 to 98 might lead you to think that now we're just throwing 30 on top of everything. We are not. Those are accurate. I don't want to let you get away without understanding a bit more of those line of business pages. There's detailed pages on 26 lines of business, with the possibility of a bonus line of business in some states where one of those other lines of business makes it into the top 10 for independent agents. Then I added in, I think Delaware is an example where accident and health is making it into the top 10. So it's added as a bonus page. You can't see the homeowners details here, but I pulled out some of the data on the left that is available to you on each line of business page. And I just want to highlight some of that for you. So how much premiums are there in Pennsylvania in homeowners in 2022? Well, there's 4.2 billion. That is the top of the right pie chart. It's also in the table below to give you the exact number. You can also quickly see on any line of business that's in the top 10, that pie chart is your visual trigger for that. Homeowners is the second largest line of business for independent agents in Pennsylvania, so that's there. You get to see that growth rate overall. Clicking on the right spot there. There's the growth rate, and that is the difference between the total premium in 2021 and 2022 in Pennsylvania. You get the 5-year average. That also is available, and these numbers are actually in the tables below. You get the loss ratio, the last year, and we also give you the 5-year average in the title. We give you that penetration. And Jason, to your point earlier, you can calculate if that's changing. I can tell you that you can quickly see, I didn't mean to do that. You can quickly see that the overall is growing, because the 5-year penetration is in the title up here. Right here.
56%, yeah.
Yeah, the 56% right there. Oh, it's not drawing for me. It tells me if it's 56% on average for 5 years and it's 61% last year, that obviously it was lower than that in the previous years, and it's growing to 61, which is a pretty good clip, a 5-point growth over the average, which means that it was probably even less than 56 in some of those prior years. We give you the number of active carriers, which in some lines is more interesting. Like if you're talking to somebody about medical malpractice and they're saying, why don't you go to the market? It might be nice to know the active insurers on that line of business. Here we have 205 active insurers on homeowners in Pennsylvania. 150 of those are active with the independent agent channel, 19 exclusive and 28 direct. This is important to me always with my fixation on surplus lines. There's almost no surplus lines in Pennsylvania in homeowners. So if you have a surplus lines placement in Pennsylvania in homeowners, it's a unique situation. That generally speaking is unique across the country. Some states get into the homeowners surplus lines placement in the 2 to 3 to 4% range, and that is increasingly the case as homeowners is harder to place in some of the riskier areas. You get the top 5 carriers groups. That's State Farm and homeowners. The largest independent agent writer in Pennsylvania and homeowners is Erie. Probably not a surprise to you all. I used to have my homeowners insurance with Erie back in Maryland. State Farm Fire and Casualty is the largest exclusive policy issuing company. And again, you get the top 3. And the biggest direct is a USAA company in homeowners. And then finally, we do give you the surplus lines in the bottom. We're almost out of time, Jason.
You provide those for the 26 lines that you've been highlighting throughout today, which is nice. So just for reference point, correct?
That's correct. All 26 lines have a page exactly like that homeowners page, from everything starting with aircraft and going through workers' compensation. and everything in between.
Good.
And of course, the data is rich and deep. You have to limit, and the font gets pretty small already for older people like me. But I fit what I can on a page, but obviously there's more data there. And Jason, how are we on time? It's 11 o'clock. I did have the 3 kind of quick examples.
So
are we
as
okay?
I mentioned, this is being recorded. So if anybody needs a drop off based on time, you can certainly access the recording. But I think we can summarize with the most interesting things. Paulus is always well received, and then any final questions I'll gather as you're doing that, and we can wrap up. So yeah, we have time to wrap up.
All right. Well, these don't take a terribly long time, but I think what they do is they serve as an example of what I referred to before as the raft of ducks on the shoreline, or the killdeer chasing bugs. The more specific you get, I can tell you with almost without exception, the more interesting the data always is, and the more enlightening it probably is for the average independent agent. So think specifically, and then ask yourself whether the data is there. And in my retirement project here, if you ever have a question you just want to ask, don't hesitate to reach out to me by email or on the phone. I do this work for a lot of independent agents across the country, and it's always interesting and fun. And a question is free, and oftentimes that's all it takes, or I can tell you what's available and how you might get it. But yesterday, when I was thinking about Delaware, it hit me right between the eyes as I was looking at the Delaware report that when I pulled the data, it didn't include the Nuclear Electric Insurance Limited Company. They filed their data quite late this year, almost 2 months after most insurance companies did, and I just missed it. And I had profuse apologies to Claire and her team. Before that, I caught that, added it in, and revised the entire Delaware report to include that 180 million in premiums. But it's a great example of where it was very easy for me to see what was missing and look to see what it is that they do. I was not personally familiar with what they call NEIL, N-E-I-L. It is an admitted carrier in Delaware that writes premiums for, I presume, the nuclear power plants. All of that premium hits the Delaware data, and you can see that it's very easy to go and pull the sorts of data that you can on the industry for an individual carrier. I have something called an insurance snapshot tool, and some of the states have been taking advantage of that. I think I ran one of those for Pennsylvania the other day, where you can see the premiums, the direct written premiums in a state. These are the Delaware premiums, and the loss ratio, which this is a great example of a loss ratio that's been pretty good on average. I mean, it looks like in 2014 they had a tough year, but for the most part, those loss ratios are pretty good. So that's my Delaware example. In Maryland, the thing that jumped out at me is when I see the penetration rate in Maryland, I think it's 51. It surprised me, and here we have the trends in the 5 components, both for Maryland on the bottom and the United States at the top. But it quickly jumps out to you, and having been a resident of Maryland, I know the biggest driver of that, which is Geico. But that direct line is 37%, and fairly flat in 2022 versus the United States average of 26. That 11 points is for a large part on personal lines, mostly auto and homes. The difference as to why the Maryland penetration on those lines is lower than it would otherwise be, and that's Geico, and a great example of marketplace evolution, evolving to go after premiums that they thought were profitable. Here is an example of that private passenger, which is the largest line of business, and this is the Maryland page. You obviously can't see that, just making the point that that's there. But from that page, and then I did a little bit digging beyond the top 3, or the top 5 rather, you can see the groups that are big in personal auto, which is largely driving that lower penetration. Geico, of course, and then State Farm being exclusive, Allstate being mostly exclusive, Progressive in that case, in that state, I think largely direct, although they do have some agent-friendly insurance policies there as well, and then USA, and then you get to Erie, Nationwide, Liberty, and Travelers. So you can kind of see that $5.7 billion in premiums is really dominated by some pretty advertising heavy direct or exclusive distribution. So another example of how you can answer a question. And the third one I'll touch on, but an example in the news yesterday, or last week rather, but I think I read it yesterday, was a great example of what I see in the news in a carrier I may or may not be that familiar with. And I turn to the data to very quickly become familiar with it. I've never been appointed by Hanover and have not come across them in my many years of, I mean, I've come across them. I know who Hanover is, a Northeastern-based company, but I wasn't really intimately familiar with them. So when I saw this and I saw the reference to homeowners, I said to myself, well, if I was an agent in Pennsylvania, I'd probably ask myself, is that a big deal if I didn't know in my state? And fortunately, I can turn to that snapshot tool to very quickly look at that. Now, this is the entire Hanover Insurance Group. This gives me a sense of all of their top 9 lines of business. If you recognize this pie chart, it's the same sort of pie chart that you have in your marketplace summary for all the distribution and the independent agent distribution and the top lines of business. So I can see homeowners is the 3rd line of business. I can look quickly and see what their largest states are. Pennsylvania is not listed there, so it falls in the rest of the states. Then I can turn to the Pennsylvania only data. I quickly see that they've got 140 million in premiums. So, you know, even us who are not whizzes at fast math, 140 out of 5.9 billion is not a huge percentage. But I can see that homeowners is still their top 3, their 3rd biggest line of business. I can do some quick Aggie math on that. At 16 million in premiums, I usually divide it by 1,000 to 1,600 for a typical non-coastal type homeowners, and 10 to 15,000 insureds in a state that probably has households in the tens of millions. So it's not huge. But again, just showing you that perspective. Quickly, you can look at their overall Pennsylvania, because this was a Pennsylvania example. I pulled the Pennsylvania data. How are they doing? There's their calendar year adjusted loss ratio. There are their premiums, 114 to 140. They are growing. That is a pretty good clip. Look like I wrote it down, but I'll bet you that's 20%. I can tell you that that loss ratio for all lines is higher than Hanover wants it in Pennsylvania. So if I was competing against them or it was one of my companies, I would expect some underwriting changes and or premium increases. And then we can, just making the point that the lines of business data is available, and being one of the top 10 lines, that snapshot tool I have just pulls that out, and I can look at homeowners in Pennsylvania. And yeah, that does look like a book of business that's growing. Number one, you can see with the premiums in Pennsylvania, but it's also not that profitable, right? We wouldn't want the contingencies of that book of business in our overall book of business because there wouldn't be any contingencies on it. And so last but not least, the commission data is filed, so I can very quickly look at what Hanover pays in the United States overall. Hanover Insurance Group is listed there for all lines combined, and then homeowners specifically, and that is specific to Pennsylvania. And then you can look up the independent agent focus carrier average and the overall Pennsylvania average, which is always lower because you've got the directs and the captives in that. And then the last slide is that quarterly data that we talked about. And this is all of the Hanover companies in Pennsylvania. It gives you a sense as to what those quarterly marketplace summary reports show you for the entire state. This is just all the Hanover companies combined. The loss sensitive measure on the bottom right is as good as you can do with the quarterly data. You don't have earned premiums state by state, but you use the direct written premiums, and it gives you a sense, are they feeling some strain? And what that tells me is it's above the average line of 59% for that time period in the state. So yeah, it speaks to what the marketplace article was about. They're going to be adjusting their underwriting and homeowners and probably increasing prices. So Jason, I hope I didn't overstay my welcome too long in those examples, and I hope they inspired somebody to think about a specific question that they have and maybe how data might help them. And
Yeah,
I'm
no,
happy
not at
to take
all.
any other questions. So.
Sure. The commission that was specific to one carrier, but sort of segue in the final question. Some concern perhaps that commission cuts are a natural result of the hardening market as well, and as a way for carriers to perhaps adjust results on their end. Is that something you're seeing? You showed that one specific carrier, but across the board. Is it too early to be seeing commission cuts, and is that a natural byproduct of hardening market?
I think every carrier looks at how they do business, but I think the strengthening hand of independent agents in the marketplace generally in solving problems doesn't lend itself to a commission cut. The business becomes more expensive for all of us to do. I think there's lots of reasons why commissions would not fall in that environment. That doesn't mean that there isn't a carrier out there that won't turn to that because they have to, because of profitability. Or I think what I'm seeing more of is carriers moving to managing general agents and maybe offloading some of their expense ratio into a higher commission through an MGA, which then ultimately might be a lower commission that makes it to a retail independent agent. So a lot of thoughts there. I don't know. I think it's nice to be able to track. But I will make this point that the filed commissions by carriers state by state and line by line includes contingencies. So keep that in mind.
Yeah, good point.
In some lines, some lines that's not much, but in other lines it's significant. And so you'll generally see commissions go up after profitable years because the contingencies go up after profitable years for a carrier or a class of business or a state. They fall after unprofitable years. So I can only imagine if we looked at Hanover's commissions, they're maybe a little bit compressed because chances are whatever contingencies they were paying were a little bit lower in 2022.
Right.
So yeah, that slide, I think I glossed over that. I did have a bullet on the commissions to make that point.
Well, and a reminder, as Paul has mentioned, IA&B does subscribe to the quarterly update, so we will we'll monitor as he reviewed. This is information from 2022 and the years prior, but we will get quarterly updates on this. And with the state of the market right now, we will be watching closely some of these items, where the premium, where the loss ratio goes, and we'll keep an eye on that commission as well and see what trends we might see throughout the year with those quarterly reports. Paul, I think we have covered all questions that came in throughout the webinar, so we're good there. You have Paul's contact information on the screen. Feel free to reach out to him with any questions that may arise as you perhaps get into the reports and dig into them a little bit further. Of course, you can reach out to us at IA&B and we can assist in any way as you review that. A reminder, those reports are available. The full reports are available to you now on the member resource section of our website. We'll be highlighting these reports over the coming weeks, so Agent Headlines will have direct links into that. But you can find those on our website. All 26 detailed pages by lines are in there, and already some interest being generated, Paul, from this group wanting to get in and dive into that. So Paul, thank you as always. We appreciate your time. We appreciate your work on these summaries. Again, this is our second year and it continues to grow in interest and demand from membership. So I think that will continue throughout. So thank you very much for that. We will be working with you closely with those quarterly reports and as our members sort of dive into this and really tell us where they have some interest and where they want to go. We have that ability now with these reports. So thank you, Paul. To our members, thank you for your participation in today's webinar. We will be following up with information. As always, if you have any questions on this or anything related to the independent agent channel, reach out to us at IA&B. We are here for you. Thank you for your membership and have a great rest of the day. Take care, everybody.